Morning, everyone, and welcome to the latest in Arlene Close's Trending Treasury series of webcasts. My name is Nick Keeling. For those of you who don't know, it's nice to see a lot of names I do know and introduce myself to a lot of names I don't. This morning, I'm discussing the economic years ahead, 2021 and beyond, with Richard McGuire, head of rate strategy at Rabobank. This is actually Richard's second appearance on Trending Treasury, the last being towards the start of the pandemic. So it'll be interesting to see if the events of the past year, and boy, have we had a number of interesting events, have actually prompted a change in his views. So we'll be discussing that. So morning, Richard. It's good to have you with us again, and I hope the weather where you are is slightly less miserable than where I am.
Morning, Nick. Yeah, no, it's a pleasure to be back, and I'm afraid, probably equally miserable, I'm afraid.
Good old January weather, really lifting our spirits at this difficult time. Well, let's head into it. I think, to be honest, Richard, I think this will lead into the kind of the first thing I want to talk about, which is a kind of a recap of recent events. You're fairly unusual with regard to economic commentators because you take risk positions. You actually execute financial trades based on your views. Which is good for us because you're putting your money where your mouth is. So it's not just a paper exercise for you, but it does also leave you open to you can't get away from when your views are incorrect. According to market movements.
Yes.
And that brings us nicely on to what's happened since the start of the year. US Treasuries have increased very, very sharply. We have had a rise in equities. So I just wondered if you could give us an idea, of any trades that you've placed, how have they done in this environment, and what's been driving this rise in yields?
Yes. Yes. So as you say, Nick, we do trade these ideas, which can sometimes be painful, which it was at the beginning of this year, because we were last week cut out of a trade. Which was a US curve flattening trade. We were buying 30-year US bonds versus 5-year. So the idea was that yields at the very long end of the US curve would fall relative to those at the shorter end. And the thinking simply was that when we put on this trade at the beginning of September, that the market was being overly optimistic. We had the first wave of the virus. Through the summer months, matters appeared to improve, but we argued that heading into winter, things would deteriorate again as the weather got colder. People have to move inside. Infection rates would then pick up, and we would enter a second wave of infection that would cast some doubt, or certainly downside risk, in terms of the outlook for demand, the outlook for the economy, and that should see longer dated yields in the US, as we were trading, fall. Now, the market has resolutely refused to get on board with that idea. It appears very clearly that investors only have eyes for a vaccine-led recovery and have enormous tolerance for a virus-led downturn. So I think our outlook was correct. Clearly, we are in the throes of a very serious, in fact, more serious now, second wave of infections, not just in the UK, but across Europe and much of the developed world, including the US. That clearly must dilute or delay any notion of a recovery, most likely both, but the market has simply not responded to price that in. Yields, as you say, have risen, and I think a large driver behind that move higher in yields has been the US political developments, the US elections. Originally, the market had anticipated that the Democrats would do very well in those elections, with a convincing win as regards taking the White House and the Senate and the House of Representatives. In the event, it was much of a less convincing win, and the Democrats only have the narrowest of majorities in the Senate. But the fact of the matter is that has been enough for the market to now expect that there will be more budgetary support, more fiscal support for the economy, and that is helping insulate the market from the gloomy and worsening conditions on the ground currently. So it's underpinning higher inflation expectations, the outlook for possibly, if not more likely, more supply in terms of US bonds being issued to fund the Democrats' generous fiscal plans, and that has pushed yields higher. So against or in contrast to our view, and even as matters continue to deteriorate, as I said, the market appears very willing to look around an increasingly large corner and is ignoring the virus and focusing purely on the vaccine.
Thanks, Richard. A full response as usual. I should be used to that. It's interesting what you said about supply. There has been events that have driven this kind of, like you say, this look through better climbs ahead. So we'll ignore what's going to happen over the next 6 months or so. But I noticed that I think I'm right here that there was a Spanish government auction yesterday, which was hugely covered by demand.
Yes.
Something like 130 billion euros bid on. I don't know what the actual issue size was. You probably tell us that, but it suggests to me it almost doesn't matter how much debt is going to be issued, that there's a huge amount of demand there to hoover it all up.
Absolutely, and that is a key theme also, certainly over the longer run. When considering the longer term outlook for global yields, for interest rates, we do not believe that rates will head sustainably higher from here due to financial repression. As you said, there was, in fact, it was record demand for Spain's 10-year syndicated issue, which in itself is not particularly newsworthy, because at the beginning of each year we continue to see new records set for these syndicated issues, which of course reflects the fact that central banks have been printing ever more money, and certainly prompted by the coronavirus. You've seen very aggressive responses in terms of central banks on both sides of the Channel and the Atlantic hitting the printing presses. So there's an awful lot of money that needs to be put to work. The ECB, for example, will absorb more than will be issued by Eurozone governments this year, and much more than will be issued, despite the extraordinary issuance pressures which these governments find themselves facing. The ECB is purchasing such large amounts of debt that the actual supply of debt is going to be notably smaller at the end of this year than it is at the beginning. So there's a lot of information, a lot of money chasing supply, and that's where financial repression comes in. Governments using central banks as their agents are effectively forcing yields lower. It's either yield curve control in outright terms, as the Bank of Japan is officially pursuing, or unofficially, the ECB calls it favourable financing conditions. But the upshot is the same. The governments are issuing record amounts of debt, but central banks are hoovering up in some instances much more than is being issued, which is simply forcing demand, forcing investors into the market to look for decreasing amounts of supply and keeping yields capped. And that is likely to continue, because one legacy of the virus, of course, is the explosion of indebtedness across the developed world. And so the consensus that higher debt will see yields rise, I think, is looking through the wrong end of the telescope. It's precisely because of this debt that yields cannot be allowed to rise, because these debt burdens would then prove to be unsustainable.
Yeah, so it's a good viewpoint, to be honest. And we might have had some concerns before we saw that Spanish auction. That kind of brought the whole thing crashing down again, and certainly led to a fall in yield yesterday in the UK. I think that was one of the main drivers. I don't think we can get away from the fact, though, that in 2021 there is going to be a rise in inflation, isn't there? Mainly because of the base effects, perhaps, of last year, mainly because for the UK for Brexit reasons, or maybe just because there will be a recovery, in demand at some point during the year. Inflation is likely to rise in the near term. Do you think? I mean, how far do you think that will go? And also, do you think that will be sustained?
Yeah, I mean, there's a couple of points then. Firstly, the market has been trading this so-called reflation theme, this idea that inflation will recover in the wake of the virus. It has been trading this for a number of months now, and that was, as mentioned at the top of the programme, one of the key reasons why, unfortunately, our 530s US flattening trade ultimately didn't work. But because of that, we've already got quite elevated expectations in terms of the outlook for inflation. So 10-year US break-evens, so that's the market-based measure of inflation expectations 10 years into the future, is now pricing in more inflation over that period than at any time since 2018. So that would appear to imply then that the market not only does it expect a recovery of inflation on the back of a post the virus, on the back of a recovery due to vaccinations being rolled out, but more than that, the inflation pressure will actually be higher after the virus than before. So that's something we dispute. We agree, you're right. Inflation rates are more than likely set to rise going forward. Part of that, though, is mechanical, because inflation was so weak last year, and then that naturally pushes up inflation rates this year when you compare them to the lower base in 2020. So that's something mechanical or mathematical. Plus, yes, we certainly have sympathy with the idea that hopefully, as things get back to normal later this year, that there is demand which is being pent up. I'm sure everybody listening now is desperate to get on a flight to somewhere warm or to head out to a restaurant. So there will be a notable rise in demand as things get back to normal, and that also could put upward pressure on inflation. But over the medium term, over the longer term, and that is important for longer dated interest rates, for example, we simply we don't see it, and this is something that we think the market is again underestimating, and this is that things don't go back to normal once we achieve herd immunity, which we hope to at the end of this year. There is a legacy from the virus. We don't go back to 2019, 2018 once the shops reopen. Many shops are never going to reopen. There will be a legacy in terms of millions of unemployed. People are going to lose their jobs permanently. To put that into perspective, the University of Chicago estimates that 42% of all Americans who've lost their jobs have lost them permanently. Well, that would equate to more than 9 million, which compares to 6.8 million at the peak of the global financial crisis, for example. Plus, you have the fact that clearly businesses are under considerable pressure. Many have not been able to operate or generate revenue for months. And just as with this army of unemployed, this picture is obscured by the fact that governments have rolled out extraordinary support schemes. But once these support schemes are withdrawn, then the legacy of the virus, the permanent damage, will be clearer. And that, for us, is likely to be a drag on inflation rates, on demand over the longer run. Plus, there are other structural issues. We'll all probably going to be working more flexibly going forwards, working from home sometimes rather than always in the office. And I would expect that companies will be happy to allow for that, not necessarily out of the goodness of their hearts, but instead of higher wages rather than in addition to higher wages. And that's a structural argument behind the limited wage inflation, not least because of the army of unemployed in the wake of the virus, which again does not to us speak to higher inflation over the longer run.
So you see, I know that you don't focus on the UK in terms of your rate views, but when you see, for instance, the Bank of England's monetary policy report, which I'm sure you do glance at, with the unemployment forecast coming down very sharply over the next few years from where it peaks, In your view, then, are those kind of forecasts very very optimistic?
Well, I think certainly unemployment rates hopefully will come down because over time, where businesses have exited the market, have gone bankrupt, then one would hope that over the longer run, new businesses will enter to fill that gap. Obviously, again, there's going to be this structural change. If everybody's working 1 day a week at home, let's say, then that's 20% fewer coffees from Cafe Nero, 20% fewer sandwiches from Pret a Manger. So there is this big structural rebalancing, which is likely to happen. This doesn't mean that unemployment rates will be permanently higher over the very long run. But I think what we are underestimating is the fact that once the dust settles, once government support schemes are withdrawn, that we will see a surge in unemployment rates globally, and very possibly a surge in corporate default rates, which will take some time to address as the economy finds its feet going forwards.
Okay, thanks for that. So we've kind of touched upon this already, I suppose, but maybe describing your medium term view or medium to long term view more thoroughly. You've mentioned financial repression already, and I know that's a key plank of your view. Or maybe we can talk about secular stagnation. We did do it in the last webcast we took part in nearly a year ago. I wonder if you can give and kind of again bring central banks into this, bring coronavirus into this. What is your general medium-term view for rates, and how has recent events? I think you've drawn on this already. How have recent events either raised risks to that view, I suppose, or actually accelerated, actually supported that view?
Yes, I think because you could argue from the vantage of the coronavirus, if you're an optimist, which of course, Nick, that we're not. If you were an optimist, though, you could say, well, maybe things will change because of the virus. That for example, we now realize how important low-income workers are. Many of them are termed in the UK as heroes, and it's not just nurses and doctors, but it's delivery men and women, postmen and women, people who operate public transport, shop assistants, anyone who needs to be in the front line to ensure that the economy can in any way function. Who take a risk doing so. We now realize how important their services are. Perhaps that creates political support or popular support for paying these workers a fairer share, a fairer slice of the pie that they're helping to produce. Maybe that will trigger wage inflation. Another upshot of the virus is, as the optimists will have us believe, is that we now realize how vulnerable we are to international supply chains because of COVID. So that's increased calls for bringing output home, for onshoring output from overseas, insofar as that insulates domestic workers from cheaper foreign competition, then that should also push up wages. So could we see, in marked contrast to what we saw before the coronavirus, finally, at long last, Labour enjoying a fairer slice of the pie that it produces, faster wage inflation, faster demand pull inflation, and ultimately companies who want to maintain their profit margins as wage pressures grow will need to invest more in productive assets, which is something that they've avoided for many years, which again is a key part of our lower for longer rate view. But unfortunately, the virus has actually accelerated many of the themes which were behind the lower for longer rate view. One of them being inequality. Companies for many years prior to the virus, as we have argued, have been investing not so much in productive assets, but rather non-productive financial assets, undertaking financial value engineering, buying back their own shares, taking over competitor companies, which doesn't boost output, it moves output, but it's good news for shareholders, good news for share prices, but bad news for labour, bad news for income. Well, this inequality is only set to accelerate massively because of the virus, because the virus is having a disproportionate impact on low-income groups, and that inequality, we argue, was a key determinant behind populism, behind the rise of social tension, geopolitical risk, and that informed our lower for longer yield view because of the need for safety. Investors looking for insurance against the backdrop of an uncertain and politically volatile environment. This is only accelerating because of the virus. You can see it with the violent insurrection on Capitol Hill in the US, or Black Lives Matter demonstrations in the US. Inequality has increased massively because of the virus. Social tension, geopolitical risk is likely to as well over the longer run, which is another reason why we expect yields to remain lower for longer. Sadly, we don't expect that that companies will begin to invest in more productive assets after the virus, because there's a demographic imperative which has informed the financialization process, as we would put it, which is we live in societies where there are more older people than younger people. So there's more political pressure for revenues, for output, for profits to be directed not towards labour, not towards income, but rather towards financial assets for the benefit of the older members of society who are looking at arguably unrealistic pension fund promises. That demographic imperative is still with us. It's unavoidable. It doesn't matter whether you're a Republican or a Democrat, because politicians are players, but the game itself is structural. It's demographic. That's why we've seen a cannibalization of demand away from the real world in favor of the financial universe. That imperative is still there. That argues that in the wake of the virus, you won't see deglobalization. You won't see higher wage pressure. As I've said, people will be able to work more flexibly afterwards anyway, instead of higher wages, one would argue. You won't see, as I said, faster productivity growth. We'll see higher inequality like we did before, more financial repression, and zombification. Low yields, which we believe will be a legacy of the virus, in addition to the fact that those corporates that have managed to survive will survive with an enormously larger stock of debt, means you'll see many more zombified companies that are on life support, and as such they're insulated from market forces. They don't need to be efficient. The pressure to invest in productive assets is simply not there, and they can happily undertake financial value engineering, which means whichever way you look at it, it's still probably good news for risky assets, for equities, again from a financially repressive perspective, but it doesn't mean that that will be accompanied by higher yields. In fact, we would argue that low yields are a necessary condition for higher equities, not least because a notable move higher in yields, as mentioned previously, would see the debt stocks which developed world governments are set to inherit proving unsustainable.
But surely, Richard, what about all this fiscal stimulus? What about all the monetary stimulus? I mean, it's got to do something. It's got to drive some kind of activity somewhere.
It does. Excuse me one moment. That's the benefit of working from home. In terms of monetary stimulus, we've seen ever greater monetary stimulus for decades. The Bank of Japan is now in its third decade of quantitative easing. They have not been able to generate the inflation pressure that they have wanted, and notably wage growth has remained decidedly contained there. So clearly, Japan has shown that monetary stimulus is not a path towards higher inflation. And as we have argued, we are in fact all turning Japanese, not because we have the same problem, but rather because we have the same solution. And this idea being that if you target financial assets through quantitative easing, you generate demand. But our view is you don't. You simply generate demand for financial assets. In fact, you cannibalize demand away from the real world. Now, fiscal stimulus, that has a far greater chance of succeeding in generating an inflationary impulse, because, of course, now, rather than buying financial assets, which only benefits those who are long financial assets, the wealthier members of society who have a lower marginal propensity to consume, so their increase in paper wealth does not translate into higher demand, higher inflation. Fiscal stimulus, the building of bridges, hospitals, infrastructure, green technologies, this offers greater hope for a generation, for the generation of longer term inflation pressure. But there's two caveats there. First, again, we think the market has got ahead of itself. We have seen very sizable amounts of fiscal support from developed economies, the UK, European countries, and the US, plus others. But that is not stimulus. That is relief. The impact of the virus on private sector demand has been so significant that even the enormous fiscal response that we have seen has only limited the downturn of growth, but it has not, in absolute terms, increased demand. To put that into perspective, we would estimate that the US GDP nominally may have contracted by 17% last year if the US had not rolled out its extraordinary fiscal support. But in the event, it's likely to contract now by 3%, but it's still a contraction. This distinction is key. It's relief. It limits disinflation rather than stimulus, i.e. promoting inflation. Over the longer run, the other caveat is, yes, fiscal policy certainly provides much greater optimism that we will be able to generate the inflation that has eluded us for many, many years. But Japan has been there. They paved riverbeds in the 1990s to try to boost demand. China has arguably already effectively been pursuing MMT, monetary theory, through the last decade. They built roads to places nobody wanted to visit and tower blocks that nobody wanted to live in. This did not generate longer term inflationary pressure. So the key point is that fiscal stimulus needs to be directed to the most productive ends of the economy if it is ever likely to be able to generate a longer term inflationary impulse. And the recent precedent, if we look at Japan and look in China, is not that favorable.
Yeah, thanks for that. Okay. Just we are running close to time. Very interesting so far. I think perhaps on the closing comment, maybe a lot of our clients are borrowers, so very interested to hear your views on longer term yields basically remaining quite depressed. Might move around in the short term based on inflation expectations, but the longer run viewpoint is not for a spike in yields. Have you got any thoughts about negative rates? So a negative rate environment, like I said before, you're not focused on the UK, you're more focused on Europe, where there's been negative rates for a long time. Do you think negative rates actually work in terms of what they're meant to do in terms of central bank policy response? And kind of do you see negative rate policy around the world persisting and perhaps even the UK itself entering that group?
I think of the longer run, negative rates. I mean, we already have. I mean, I think it's important to note, as of course your listeners are very acutely aware of, there are negative rates in the UK. You've got negative yields at the front end of the gilt curve. It's just not yet a negative policy rate, but the market is flirting with pricing that in. In terms of do we think that negative rates succeed? Well, no. As mentioned previously, monetary stimulus over recent decades has clearly shown itself to be not so much pushing on a string, but rather succeeding in generating asset price inflation, so higher equity valuations, higher value of corporate debt, for example, but at the cost of real world demand. Negative rates are just a continuation of that trend. Developed world in short-term interest rates have been falling from the end of the 1980s. The fact that they're entering negative territory is simply because of the very long-run nature of this development. But there is no change in impact. It's more of the same. It results in greater cannibalization of demand away from the real world, and zombification is a key feature of that. Many large corporates now, such as Henkel or Sanofi or Louis Vuitton, are able to issue short-dated debt with a negative yield. So they're paid to borrow. Now, the risk of defaulting, if you're paid to borrow, I can calculate in real time, well, that should be zero. It should be very hard to default unless you work really hard at it or are not particularly bright. But it is difficult. You need to make an effort. So because of that, these companies are insulated from market pressures. They're not likely to default. They don't need to be efficient. Therefore, they don't need to desperately seek out the most productive investments to boost output, to be competitive in order to be able to generate the revenues necessary to service their debts, because they are paid to borrow. So everything is frozen. There is no creative destructionism. There is no rebalancing. You're limiting market exit. Therefore, you're limiting market entry. Everything is held in stasis. Productivity evaporates.
Oh, I think we've lost you, Richard.
Equities and the wealthier members of society via corporates who act to channel that liquidity. So in answer to your question, no, it doesn't. I think we do. Ideally, we would like to see some kind of rebalancing whereby inefficient companies can actually be allowed to exit the market, freeing up resources for more productive corporates to be able to use. But for that to happen, we need to have a downturn before we ever have an upturn, and that is the issue. In a society made up of more older people with arguably unrealistic pension fund promises, it is politically suicidal to allow for a downturn and a decline in risky asset values such as equities, even if that would sow the seeds for a longer-term, healthier expansion.
Yeah, we have seen that in the past. You're right. Richard, we have gone slightly over, but that was really interesting. Thank you very much for your views today. Entertaining as always. So thank you very much for that. Just to introduce next week's Trending Treasury. Next week's will be accounts close down themes for 2021. No doubt a riveting discussion with Stephen Kitching and David Green. So hopefully you can tune in for that, and hopefully there'll be some useful information on the accounting process for this year. And on that final point, I don't see any questions from any of our attendees. So thank you everyone for attending. Thank you again, Richard, for speaking today, and I hope to see you all next week. Thank you very much.
Thank you, Nick. Thank you, everybody. Bye-bye.